Welcome to Multifamily Insights. I'm your host, John Casmon, and I want to thank you for joining us for another great episode. If you are enjoying this show and getting some great value for your investing goals, let us hear about it. Leave us some honest feedback with a rating and review. It helps us, but it also helps other listeners find the show for their own investing goals. Now, we got a great show today. We're going to be talking to Thomas McPherson. How do you get the highest rents, the highest occupancy, and the highest retention in your market? Well, today we talked to Thomas McPherson, and he shared how he's able to do that, focusing on not demographics, but value graphics. That's right. So we're going to have this new conversation about value graphics and understanding how to achieve the top level KPIs for your apartment investments. And on top of that, we talked about distressed debt and some of the different opportunities that are out in the marketplace today. You want to check out today's conversation with Thomas McPherson right here on Multifamily Insights.
Thanks so much, John.
Absolutely. Hey, Thomas, I went over your bio and background at a very, very high level. Why don't you take a couple of minutes and fill in some of those gaps?
Great. Well, as you alluded to, I started my professional career in the Navy. I spent 5 years serving in the Navy as well as the Marine Corps. I was stationed out at Camp Pendleton for most of that time, and it was amazing. It was an amazing experience. You know, people ask, what was it like to be in the military? And I always say it was whatever you make of it, you know, as is true with nearly anything in life. It's whatever you make of it. Some people, they did not enjoy it, but I really did. I felt like I was getting paid to be in great shape and learn and be a lean, mean, fighting machine. So that was a ton of fun for me, at least. And there were some downsides as well, obviously. But getting out of the military, for me, it was a seamless transition right into real estate. The economy was really in shambles. We were right at the start of the Great Recession. And fortunately, I just happened to decide to move to Phoenix to pursue a career in real estate. Got started off in real estate brokerage, and I just started hitting it out of the park. You know, I won Rookie of the Year for my company nationally and had a ton of success. I did that for just a couple of years. I was actually a broker, multifamily broker. Got recruited to go work for the largest brokerage firm in the U.S., which at the time was Hendricks and Partners. And eventually, I decided to switch to the dark side and go be a principal and start putting together investment groups and buying my own properties. At that time, you know, the market was really heavily distressed. And so I really cut my teeth buying distressed properties, REOs, short sales, as well as a lot of distressed debt, a lot of, loans, again, that were in default and resolving those. So that was kind of the first 5 years of my career. And I touched not only multifamily, but at that point I touched office, industrial, retail. And then when the market started to really turn around in a big way, I got interested in development, in particular, high performance development or high sustainability development, because I have a core belief, a philosophy that demographics is a very bad way to bucket people. You get very bad alignment of the people that are in those buckets. You know, that Venn diagram, if you will, only overlaps a little bit. But if you bucket people by their values, you get much more alignment across the people in those respective buckets. And so, there's a whole segment of people that identify as people who care about their health and the health of the environment and our natural resources and community and so on. And so the buildings that I've been developing lately have been focused upon those set of values. And we've done really, really well, exceedingly well. Our last big project that just completed won Sustainability Project of the Year for Arizona.
Wow.
And it's been a fantastic run. So that's what I've been up to the last few years. I've also been running a private debt fund. So, we're out there helping to not only build, but we're also financing folks in the investment space as well that are out there either doing a fix and flip, building a house or fixing that house, bridge financing, or ground up construction.
Yeah, I love it, Thomas. A lot of experience there. You talked about your time in the military, both in the Navy as well as in the Marines, transitioning directly into real estate on the brokerage side, winning Rookie of the Year honors, and then scaling to the largest brokerage firm in the country, then transitioning to being a private investor yourself, growing that portfolio, finding deals that were distressed, also look into distressed debt, and then ultimately getting into development. So today you focus on ground up development as well as private debt opportunities. I want to go back to that transition though, because many of our listeners, you know, they're trying to make that leap, right? To go from maybe having a handful of investments to how do I make that full transition, either as a passive investor or an active investor, but I want to leave what I'm doing today to make that transition. How did you prepare for that coming out of the military?
Well, I was fortunate in the sense that at the time I didn't have a family. I've got 2 kids now, an amazing wife, and so my expenses were relatively low. And I think that that would be folks that really want to get into this space and do it full time. There's 2 ways that you can have more disposable income, and everyone tends to focus on making more money. The other part of that equation is keeping your expenses as low as you possibly can for as long as you possibly can until that snowball of money that you've got coming in exceeds your expenses, by a factor of 2 or 3 or 4, right? So that would be just a little bit of insight. Also, another thing that I found really useful and great advice is if you can work in the industry in some capacity, work as a real estate agent, work as an escrow agent, work as an analyst, work as an asset manager, in some property manager, whatever that is. That way you're at least not just treading water in your real estate knowledge, depth, breadth, experience, and network. You're continuing to move forward, even if you're not growing your portfolio. So that's another one, is try and work in the industry in some capacity. But I've really found that there's really 2 types of investments when it comes into real estate to me. And of course, there's a bit of a blend, but there's assets that appreciate, that maybe don't cash flow quite as strong. And then there's assets that cash flow. And my experience has tended to be that those, higher quality assets, the A location, A assets tend to appreciate much more and don't always cash flow as strong as the, kind of the C class assets that don't tend to appreciate quite as much or retain their value if we go into a bit of economic uncertainty, which I think right now we do have a new administration that is doing a lot of things that some people don't agree with. I think our government is absolutely bloated, and we could use some cuts. Are we going about it the best way? TBD. That's not my role to determine, but I think that that's something to definitely keep in mind here is how stable do we think the economy is going to be going forward? And I always like to own better assets in an economic uncertain time. So, those C and D assets really tend to get hit hard in my experience.
Yeah, great stuff there, Thomas. First of all, you said for those folks looking to transition, a couple of things. Yes, there's the income side of making more money, but there's also lowering your expenses. So where you can, find ways to lower your expenses and make it a little bit easier for yourself. The second thing, which is a really great insight, if get in the industry.
Yeah.
Most of the thing, one of the things I love about real estate is whatever your background is, whatever it is that you do, there's probably some sort of, if not equivalent, there's definitely a role in real estate that is adjacent. So if you're in marketing, sales, again, it may not feel as intuitive as being a property manager, but there's real estate marketing, there's real estate sales, there's a lot of different roles that translate. Get into the industry. If you can switch jobs, switch careers, and start to pivot where you're at least closer to the industry, that's going to make it a little bit easier for you to make that full transition to being a full-time investor. So love that insight. And I think it's really practical and something that people need to wrap their heads around, whether you're an attorney, whatever it is you do, but get into the real estate industry. Now you're closer to it. It makes it much easier to transition to being a full-time investor. The last point you made there was understanding just how the market cycles change. New administration, lots of uncertainty there. And your position is it's better to have higher quality assets than necessarily higher cash flowing assets. So it's not to say that there's a this versus that, but the point is, the way I think of it is it's demand, right? When times are great, everybody wants everything, right? Go back a couple of years, everyone's trying to find yield wherever they could, so they would buy any kind of property. When the demand is not as strong or the economy is not as strong, well, now people are really going to focus in on the things that they want. They're going to cherry pick the assets they want to be involved in, right? They're not necessarily chasing yield with the same sense of eagerness. So they're going to be more discerning. So you'd rather have the properties that are a little bit newer, that have more amenities, that are more attractive, that have more demand, as opposed to maybe properties on the other end of the spectrum where you got to work a lot harder to both to get residents, but also on the back end exit where you're trying to sell it to somebody because maybe they have more options. So just something to think about as investors as you're approaching your investing thesis. Make sure you understand kind of that balance between cash flow, appreciation, class A assets, class C assets. It matters. And I think for a little bit of time there, people stopped paying attention to those things and just bought whatever they could because it penciled. What are your thoughts on that just as you continue to grow?
Oh, you nailed it. You absolutely nailed it. And sometimes there's some regional politics that might come into play. For example, in Arizona, I hope I remember the actual bill. It was like Senate Bill 1070 or something like that here in Arizona, which was basically like a stop and search, stop and frisk kind of a Senate bill, and that caused us to lose a large population of our Hispanic community, and the assets that were predominantly hurt by that were again kind of the B minus C assets. And in economic uncertainty, as you just alluded to, there's a flight to quality at the institutional level. And let's be really frank, the largest institutions in the US are what fundamentally drive valuations, right? Because it's the access to capital and at what those rates are. And if A assets are trading at 5 caps, well, B's will be at 6 and C's will be at 7, right? So we'll see household consolidation. I had roommates until I had a 7-figure net worth. Even into a 7-figure net worth, I had roommates. And I think if we go into times of economic uncertainty, young people will move back in with each other, whereas right now they might be living on their own, but they'll still want to live in good locations, right? They're willing to sacrifice not the location, but having a roommate. And so, there's a myriad of other things ranging from kind of the institutional buying and institutional capital sources that have a trickle down effect, as well as some, psychology and human behavioral aspects of investing that are important to keep in mind. And then the other aspect of it that I think is really important is your sanity and your health. And when times are good, as you just said, it's easy to buy C assets and cash flow and do really well. And as a matter of fact, those might pound for pound out appreciate A assets. They could double or triple in value. But the flip side of that coin is also true, that in volatile markets, in a downtrending market, those assets tend to be a bit more volatile because the buyer pool is so much smaller than the A quality assets. And so they go down in value much, much faster. And, I've seen those are the properties that are more susceptible to being overrun by bad actors or having theft, vandalism, crime, other issues that frankly slow you down in your aspirations of building a real estate portfolio. So you can certainly make a ton of money of it in those assets, but at this point in time in my career, it's basically B and above, and I don't touch anything that's not a B or B plus and above.
No, I appreciate that perspective, Thomas. I think it's helpful for investors to wrap their heads around the opportunities in the market. You focus on distressed assets, right? You talked about, hey, distressed and development. So kind of two opposite ends of the spectrum there. Can you define, and I know you do distressed debt too, so define that word for us, right? For folks who maybe aren't as familiar, this is not the thing they do every day. How do you define distressed and how are you approaching distressed opportunities in this market environment?
Distressed debt is some kind of debt, some kind of loan that is for one reason or another. There's pressure on that borrower or on that property owner, right? The project could be undercapitalized. The loan could have matured. The project could have gone too long. The property might have some vacancy issues or rents might have slipped a little bit and they're not able to meet their debt service. Or maybe there's other provisions, representations, and warranties in the loan that they're no longer able to meet. I'm sure you're fully aware of debt service covenant ratio and so on, and coverage ratio. And so distressed debt is basically any kind of a loan that is having a problem that the borrower cannot easily solve themselves. And that's the easiest way in my mind to define it. Now, oftentimes that is accompanied by late payments or being in default for a number of months. And you have a lender that's typically willing to sell that loan because they're not as savvy in the real estate domain. They're great lenders, but they're not real estate experts.
Yep. So distressed debt you talked about, again, that's an owner situation. Think about somebody going into a foreclosure, but they're not able to service that debt. The DSCR might be, lower than threshold, various reasons. But the point is, the existing lender would say, hey, we basically have a non-performing note or a distressed
Exactly.
debt, and then they're going to sell it on the open marketplace. So then this is something that you would come in and you would purchase the debt. So you're not buying the real estate, to be clear, you're buying the loan. And then what's your business plan from there? Do you foreclose on that owner, or do you try to work with that owner to get back to better payment, making payments?
Well, we don't like to, and I don't like to. Currently, the last basically 5 years, we have only been buying debt originated by other private lenders. So all of these loans have been business purpose loans. We don't like to get in the consumer debt space. It's not something that we want to do. 93% of the time, we have been able to work with those borrowers to reach a solution that benefits them. Rewind the tape 10 years ago, and the pound of flesh, if you will, came from the bank. The banks were selling at heavy discounts, and that's where you were able to get kind of your compensation for helping out and helping to resolve the issue. Now, banks aren't willing to sell at a significant discount. And so that pound of flesh is coming a little bit from the bank, but then also a little bit from the borrower. And so, there's a conversation there with that borrower and saying, hey, listen, I know you're jammed up. The bank has certain, whether it's regulatory guidelines or they just are a corporate beast and they have to kind of follow their own rules. We've got more flexibility. What can we provide you that will help you get this project done? And so, in addition to the distress space, which is a portion of our business, but we also have a large private credit fund that we're actually out there originating and writing new loans. So some of that solution can be recasting the current loan, providing additional capital, and putting them in touch with other partners that they might need to get that project done, ranging from GC help to, sometimes, I mean, I'm sure you've seen this, man. Sometimes it's as simple as, get better photos. The listing photos are blurry and the description is wrong and the square footage is wrong, or whatever those little things are.
Yeah.
It's attention to detail that oftentimes can be the primary driver.
Yeah. So in these instances, is it a matter of wiping out or buying kind of that loan from the originating lender, or is it kind of, I know there's like lot of pref equity happening right now too. So is it a combination of both, or how does that play out in your world?
My investment profile lately has been very conservative. Once upon a time, we would have done pref equity or mezz debt and really kind of tried to ratchet up the returns. But in times of at least a little bit uncertainty, we like to take a much more measured, conservative approach. What's really funny is, personally, in my 20s and early 30s, I would stick my neck out just as far as I could get it. I was all in, bet it on black, like let's go, let's go, let's go. And personally, my risk profile is pretty out there. I parachute, I pilot, I wingsuit, I do all these kind of high risk adventure sport things. But on the investment side, now that I've made some money and I've got a family, my risk profile is totally different. And so we take a much more measured approach, I guess is the short answer.
Got it. No, I think that's helpful. And for folks who maybe are in the finance space and some of these terms are maybe throwing you off, what we're really talking about is when you have someone who is not able to make the mortgage payments on their apartment. Let's just use apartments as an example.
Yeah.
They have a few options, right? When you're not able to make that payment, you can go into foreclosure from the bank. Obviously, they're going to be sending you those letters that no one likes to get about, being late. But a lot of times they'll write off their books and then they want to sell that loan to someone else. So there's an opportunity for you to come in, buy that loan, and then work with that borrower to get that loan current or to work out some sort of resolution. And there are lots of different steps in between there where sometimes they may just need a little bit of a capital infusion. So it's not buying that primary loan, but it's infusing new capital. And that would be kind of a pref equity situation where let's just say, you need another $500,000. to finish up your renovation budget, well, you might go out there and raise new money so that you can finish the renovation budget. But that capital that has just been raised, it's going to be a little bit different than the capital you previously raised or that you invested. So they're going to maybe sit, in a preferred equity means basically they have a preferred position over your LP investors. So this could get really, really complicated. But the point is, ultimately, you've got your debt, which is the senior debt. That's the first thing that's got to get paid, right? That gets paid before anything else. And then from there, you have your investors. But in between that, if you have to bring on additional debt, typically that's where those funds will lie in the capital stack. So there's a lot going on in the marketplace right now. So certainly folks are looking for creative solutions. I had a really good conversation last night with a fellow investor who has deals where they're doing capital calls and all sorts of other things like that to try to salvage it. Can you maybe just give some advice to anybody who's in that situation, either as an LP or as a GP, where they have a deal, it was performing a couple of years ago, interest rates shot up, now they're in this kind of distressed situation? What advice would you give them?
Absolutely. And we actually have one deal, unfortunately, that's in a bit of a situation that we're working through right now. But get out in front of it. These are typically not the kinds of things that go away on their own. They don't self-resolve, self-heal. So get way out in front of it. Over communicate. If you're the GP, over communicate with your limited partners, because my experience has been, and this is kind of going back to even my time in the military, it's not so much the good or the bad news that creates fear and anxiety and tension. It's not knowing, right? And so over communicate with your LPs, over communicate with your lender. They if you go dark, I can tell you from being a lender that's worked on this, you go dark, they just do what they got to do. But if you're overly communicating what is going on and telling them the solutions, and then even inquiring, hey, do you guys know anybody that can help me? Do you have any solutions that you can offer? I know that you don't want to own this property. We want to continue to own it. So I would say, over communicate and get out in front of it are the two best practices that I can kind of communicate to anybody in that situation.
Thomas, it's great to hear you say that. And it's so true because I went to a meetup. This was probably a couple of years ago now, but meet up here, and I was listening to this guy present, and he was talking about the last economic downturn, and he was like, "I had this huge building, I had lots of real estate, and I was in a situation where they were going to foreclose on this building, and I talked to them pretty much every day, and I let them know where I was at, what I was working on, what I was doing, and they essentially just let him work through it. And it took a year
Wow.
before he could actually start making payments again. But they worked with them primarily because he was so communicative about the approach. And he was, it got to the point where he was talking to kind of the president at the bank and the senior folks. So they believed in him enough to know that he was going to do everything in his power, right? So as they had their list of projects that they had to work on, they're like, we're going to give you a little bit more time and give you a little bit more grace. And it just goes a long way. I know obviously we're talking about finances and the numbers are numbers and money is money. But at the end of the day, this is a people business. It is about relationships. And the more you communicate, even if it's bad news, the better you're going to be and the more options you're going to have to try to get a resolution to that conflict. So I appreciate you sharing that and just reiterating that fact. Let's take the conversation in a little bit of a different direction. We talked about some of the development deals you were doing before, and you
Yeah.
mentioned building communities and winning these sustainability awards. Can you just talk about that a little bit more? Because I know a lot of folks are interested in development, but I don't hear people talk about, like you mentioned, the demographics and kind of that Venn diagram of people. Just elaborate a little bit more about kind of your vision and your approach to development.
Love it. So buildings consume 40% of our energy worldwide. They are the single largest contributor or consumer of energy and demand. And taking 30 seconds, I spent time in the military, and we did some gnarly stuff, that wasn't so great for a lot of people when I was deployed overseas. And now I want to focus on doing things that I think are really beneficial for society and the communities that I live in and that I serve. And so the built environment is an amazing resource. It is an opportunity. I think it is an underappreciated opportunity. It's one of the things that make us uniquely human. We spend majority of our life indoors, and we've got buildings that were not designed at human scale or in harmony with our natural environment, right? So, like, there's just little things that you can do to increase the health of the occupant, for example, right? The more natural light you have in a space, typically the lower cortisol levels, the lower the blood pressure, et cetera. So, there's different things that you can do that not only benefit the health of the occupant, they are great steward of our natural resources, both material and energy resources, and they foster building of community. And the number one predicator of longevity is your social connections, the quality and quantity of your social connections. So what we have focused on is, getting back to that kind of Venn diagram example. I don't believe in demographics as a good way to bucket people. What we believe in are value graphics. And there's a great book with the same title about values, and how if you market and bucket and talk to peoples based on their values, you will get much more both alignment, but then agreement. And so when we're building a building, let's say in downtown Phoenix, well, if you're living in downtown Phoenix, you're looking at all of the buildings in that marketplace that fit your price range, right? And they all are relatively similar. They've all been, let's say, built in the last 3 to 5 years, and they all have floor plans that are 800 to 1,000 square feet. And there's no differentiation, right? And we've heard this before, like, find your tribe, right? And so when you come into one of our buildings and you come walking up and you see that we're 80% powered by the solar panel array on the rooftop, and we've got gray water catchment, we've got some edible landscaping, we've got an electric car sharing and charging program, and we didn't use any nasty toxic chemicals inside the building. So if you've got your baby crawling around on the floor, you don't have to worry about nasty sealants and different glue and the toxicity of the building. And so what happens is you move into the building because it aligns with your values. Yes, it checked the box of location. Yes, it checked the box of price range, but you feel like you have found your tribe. And then suddenly when you're living there, because everyone else is a part of that similar set of value graphics, you make instant friends with everybody in the building, right? Hey, what are you doing this weekend? Oh, I'm going to the farmer's market. Oh, me too. Or I'm going hiking in the mountains, or whatever that is. It tends to overlap in many more ways than it would have in a normal situation. So we have higher rates of retention. My project that just recently finished, we are actually getting the highest rents in our market. That's in downtown Mesa, which is a suburb of Phoenix. But we're getting the highest rents in the market, and we've got the highest occupancy in the market. And it's because people feel like they're home, and that's really our approach. Yes, these are rental units, absolutely, but this is your home, and we want to create a space. Think of myself as a producer. I just want to make the stage so that everyone else can do what they want to do in their life.
Thomas, I love that approach. It sounds like you've built some amazing communities, and I know you've been recognized for that. So it's not just me saying that, but I
Thank
think
you.
it's amazing. And I would say for our listeners, you may not be able to do what Thomas is doing right now, but the thing that I want you to glean from his words here is it comes down to the values of the community you're trying to create, and be intentional about this.
Yeah.
It's all about the experience, and you're able to see that really translate into the financials. I think sometimes we get into some of these things, these theories about sustainability and fresh air and water and all this stuff. And some investors, I get it. They're like, that sounds real fluffy, right? Like, whatever. Like, what's the numbers? Well, you just hit it, right? You're getting highest retention in the area. You're getting the highest rents in the area. You're getting the highest occupancy in the area. This is the most profitable business that you can do, the most profitable apartment building, because you were intentional about building out that community. When people feel like they're home, when they feel like they belong, they're not looking to move. It doesn't have to be transient. Now, obviously, life happens and some folks will
Sure.
leave, but these people aren't looking to leave, right? They're leaving just when an opportunity kind of makes them revisit that. And that's a different mindset. And the experience, or the mindset I want our listeners to take away is, what kind of experience can you create at your property that will
Yes.
drive retention? And it doesn't have to be all the sustainability things, which is great. But, again, from your property management, from your greetings, from your community events, from the recognition, what can you do to stand out in your marketplace? What can you do to drive connections and those values so that you can drive retention and ultimately drive a stronger NOI. I think that's the big takeaway there. And it's something that any of us can do to some capacity on any one of our investments. What else do you have to say for folks who are looking to get into maybe more development or really starting to take more into sustainability?
Well, you don't have to eat that elephant at once, is absolutely, I think, a great philosophy. Even my projects today that are award-winning projects for sustainable development, I'm not doing everything that I want to do in these projects. You do have to make economic decisions. And at the end of the day, you try and do the most good with the dollars that you have. So you don't have to, again, do it all at once, but maybe come up with a list of 10 things that you'd like to do, whatever that is, it's appropriate for your market, and just try and incorporate a couple of those things, right? And they can be little steps. And again, that applies directly to whatever market that you're in. And what you'll do is you can also find different resources online, but you'll find that you get a little bit of inertia and you get going. And then just like when you're in a distressed debt situation, communicate what you're doing to your residents. Hey, folks, we're installing, whether it's solar panels or we're doing a rainwater catchment, or hey, one of the things that we had a ton of success with was little garden plots at one of our properties. Not everybody in the building wants to do it. I get it. But even the people that aren't participating can appreciate seeing fresh fruit and fresh vegetables right there on the property, right? It's a much more, again, sense of home. So lean into and start doing whatever it is that you can, communicate what you're doing, and then find some mentors that you can learn from in your market. And then kind of the last thing that comes to mind there is, I'm familiar, this wasn't a project that we did, but I'm familiar with another project in town here. And what they did is they actually hired someone to come and hang out with kids from 3 to like 5:30 every day. And this was like an activities coordinator, right, that just came and basically hung out and did fun things with the kids. Next thing you know, these families are now referring other families to this apartment complex, and it fills up. And then, next thing you know, this activities coordinator, there's maybe 1 or 2 parents that drop by because they want to be there with their kids and participate. And you really, truly do drive this sense of community. And I think that is one of the saddest aspects of our quote unquote modern culture is, we think community exists here when in fact community exists out there with everyone else. And those are the connections that we really find meaning and value in life.
I love it. Listen, I love the approach to community and even recognizing some of the things that your peers are doing. And it's just a great way to think about the business. If you want to learn more about Thomas and his company, check out LUKROM. Is that Lucrum? Is that right?
That's exactly right. Lucrum. It's a Latin word.
Lucrum.
We spell it just a little bit different, but it means profit, gain, advantage, wealth, abundance. It's like lucrative.
There you go. Lucrum. I love it. LUKROM.com. Check it out there. Thomas, we're going to transition to our round of insights. They say you're the average of the 5 people you spend the most time with. So if you want to grow as a multifamily investor, you have to spend more time with other multifamily investors. And an easy way to do that is to join our apartment investing mastermind group today. Just go to CasmonCapital.com and click on the mastermind button. Now, as a part of this group, you'll get access to expert trainings, group coaching calls, industry news and updates, as well as all of our webinars and workshops, including our 3-hour workshop on raising capital. Again, if you want to be around other multifamily investors that can help you scale your portfolio today and grow your network, make sure you're a part of the Apartment Investing Mastermind. Just go to CasmonCapital.com and click on the Mastermind button today. Give me a failure or an apparent failure that sets you up for later success.
Oh, geez. Which one to choose from? Okay. I've got a great one, and it's what got me going in my real estate career. It was roughly 2007. I'm still in the military, so I'm considered a very good, dependable, reliable paycheck. And I've been reading the Kiyosaki books, the Think and Grow Riches, The Millionaire's Mind, all of these things. And I was ready to transition from, conceptual academia to, real world on the streets, right? And I go to 4 different banks on the same day. And I go get signature loans, right? And so I borrow $7,500 a piece from 4 different banks. So I've got $30,000 of borrowed money. And I go open a stock trading account with a company that has since been bought out, but it was Scottrade. And I didn't open a cash account. I opened a margin account so that I could take that $30,000 and I could actually buy $60,000 worth of stocks. And I didn't buy stocks and take long positions in stocks. I actually bought options. And so I borrowed money, leveraged it, and bought options. And in about 6 weeks, I made 150 grand. And I thought I was the smartest guy in the room. Just ask me, right? Because look at what I've done. When in fact, I just got lucky. I didn't realize it at the time, but I had learned absolutely nothing. And I just threw a dart at a board, and more or less the market carried me up. Fast forward several months later, the market trades up, it trades down, a little bit sideways. It's now late 2008. The Senate does not pass the stimulus package. I think it was the TARP package, and the Dow is down like 900 points, right? And at that time, that was a huge loss, single day loss. My portfolio was down so much that the brokerage firm closed out my positions, and I owed the brokerage firm 50 grand, and I owed the banks 30 grand. So a couple of quick lessons there was leverage is a tool. You know, it's a hammer, and you can build a house with it, and you can tear a house down with it. So use leverage wisely. Number two is, if you're listening to this podcast, odds are you have all of the prerequisites that are needed to be successful. You're intelligent, you're driven, and you're out there looking for deals. Trust in yourself. You know, I was buying these stock options and stocks, and I was hoping on other people, CEOs and other leadership, to do what they needed to do, right? Instead of trusting myself and my intuition and my ability to go out there and drive different outcomes in a situation. So, you know, be really careful in your use of leverage, and invest in things that, again, you can control, at least to some capacity. I can't control the market, but I can drive higher rents by being connected to my community and drive retention. And through some of these different programs and initiatives, I can paint buildings and renovate, and I can be in control of the debt that I get, and I can be in control of my capital stack. So believe in yourself, you know, because you can. I can. There's people that have achieved quite a bit in life, substantial amounts, and trust in yourself.
I love it, Thomas. Thank you for sharing that. Give me a digital or mobile resource you recommend for our listeners.
Ooh, okay, great question. Wow, there's nothing that comes up immediately off the cuff for me. You know, I'm a bit of a book nerd. You know, it's unfortunately not a digital resource, but I'll just share my personal best practices. In the morning, I read books that I think are going to help me throughout my day. You know, currently I'm on, and I've read this a couple of times, Ryan Holiday's a great book, you know, Ego is the Enemy. And I take notes on the side, right? So I read the book and I just kind of do little circles and little stars. And then at the end of the book, I write my own cliff notes of that book. And then I'll share that book with one of the members on my team. And I say, hey, you write your cliff notes, and then let's have a conversation about the book that we both just read. And so I like to read a book in the morning that I think is going to help me throughout the day. And, you know, lately I've been tripping up on my ego. So ego is the enemy right now. And at night, I read books that I think are more fun. Right now, I'm currently on Peter Attia's Outlive, which is a fantastic book. I'm about halfway through. And, you know, I appreciate the digital or mobile resources. And lately, I've been on a personal kick to try and like shunt digital resources and get away from my phone. And so I put my phone on Do Not Disturb, and it stays on Do Not Disturb throughout the day now. And unless you're my wife or a relative, even if you text me, my wife texts me, I don't get it. I only get calls inbound from a handful of people because, you know, I'm really doing my best to regain my focus and regain my connection with everyone else in the analog world, not the digital world. So I may be a bit of a Luddite, so sorry.
All good, all good. Well, the next question is about your book. So give me the book you've recommended or gifted the most in the last year.
Yeah, that's great. Let me see if I've got a copy of, I don't see it. So there's two that I think are fantastic. I've got one over here that I'll grab real quick. So on lending, the Banker's Code is great. And, you know, that talks a lot about lending and private lending and how you can be the bank and do well for yourself. The other one that I absolutely love and I've recommended and I've probably given away more than anyone else, and I should be getting kickbacks at this point, but I'm not, is a book by an attorney out of Florida. The guy's name is Larry Loftus, and he wrote Investing in Duplexes, Triplexes, and Quads. And you got it on the shelf?
I do.
Yeah, man. So what I love about the Kiyosakis of the world is they really try and get you to shift your mindset.
Yeah.
shift your mindset from one of scarcity and one of other people can control my future and my outcome to you are in charge and you can manifest things and you can achieve millionaire status and multimillionaire status, right? But once you've kind of adopted that mindset, a lot of these books, in my opinion, they fall short on the tactical, right? They're great for strategy, but they're short on tactical. And Larry Loftus was a fantastic author who, in this book, The Investing in Duplexes, Triplexes, and Quads, laid out just a beautiful tactical masterpiece of how you can get your start in multifamily, at least, and just basic stuff, man. Like, I remember this one that he outlined in his book, and I adopted it every single time I'm at a property of mine, and I was doing a tour with a potential resident. I would walk them to their car, right? And I would just take a quick glance in the car. And is the car a pig pen? Is it a disgusting pig pen, or is it nice and well kept? Is the car clean? Does it have damage on the side of it? Did they sideswipe someone and they're just like, who cares, whatever? Or is it well maintained, right? Because how you do anything is how you do everything. So I absolutely love that book. I think it's fantastic. And I've given it to probably 50 people over the last decade who are wanting to get their start in multifamily.
I love it. I was looking around when you said it because I have the book on the shelf somewhere over here, and it is a phenomenal book, and you nailed it, because it's probably the book that gave me the most practical, not just advice, but like practical feedback of how to actually invest and be a landlord. And we started with the duplex ourselves. The next property was a 3-unit building. So like there was a lot of application from that. And I distinctly remember one tenant I had in particular who I did that to. And he showed up and he was eating an apple. He's so nonchalant, and he was with his fiance. And I remember looking at my wife and like, I don't know about this guy. But they ended up being phenomenal, like some of our best residents ever. But he was just so nonchalant, just chomping on the apple like at 9 a.m. So it's just funny. Anyway, let me get back to the round of insights here. You mentioned kind of some of the things you're doing now in shutting down technology, but give me a daily habit that helps you stay focused on your goals.
Aside from doing my best to, keep my phone on Do Not Disturb, which I think is a great one, I've been really leaning into, time blocking. Which I think is great. Like, just do what you are going to do in that period of time, and building buffer in. So life happens all over the place. We've got a policy here, kind of when the door is open, knock, come on in, let's talk. But when the door is closed, unless the building is burning down, do not interrupt me. I'm in like my focus zone. So I think that a lot of people make the mistake. There's another great book by Cal Newport, Deep Work, and he talks about attention residue, and this notion of I was at an event the other day, and this guy was bragging about how great of a multitasker he was, and I'm just like, that's not real. You know what I mean? Like, you can't do that. You can't switch from things and not have like sticky gum, those other things coming with you. So what I'm leaning into right now, my practice, because I'm by no means perfect, but my practice right now is starting one thing, putting down all other distractions. I used to have an Apple Watch. I don't wear it anymore. I don't need all the dings and vibrations and all that stuff distracting me. Doing the thing that I'm doing until I reach one of two conclusions. Number one, it's done. Or number two, I have taken it as far as I can take it and I need to hand it off to somebody else. And so, really, really time blocking and turning off all other distractions so that you can be the most productive person that you can be. I've heard, I think it was in Deep Work, but amazing stories about, Teddy Roosevelt when he was at Harvard, about how the guy would just kind of lock himself in his room and study straight for 3 or 4 hours, no bathroom break, no food break, no water break. And he was absolutely crushing it. And he was, an amazing boxer and he was, a published author, I think at 19 or 20 at Harvard. So you can absolutely do it, but we are allowing ourselves to be distracted and reducing our productivity. People always talk about, I don't have enough time. I'm going, well, how much time do you spend on social media? Get that time back.
Right. I love it. All right. Give me your number one insight for being a successful developer and distressed debt investor.
Stand out. Stand out in a sea of sameness. That can be in design, that can be in marketing, that can be in doing more sustainable stuff. So you have to stand out and get noticed in whatever capacity that you want to do that. But in some capacity, you have to. Another little thing that we do here is, we write thank you letters, like actual handwritten thank you letters. Anytime we close a loan, when we're originating a new loan, or we're closing a new deal, or whatever that is, even if we just take a meeting with a prospective investor, we do handwritten letters from whoever that primary point of contact is, and then the whole team signs it. And it's those little things that you can do to differentiate yourself. Again, you don't have to have, I've done this, like mohawk and crazy things and hair and all that. You can just do the little things that get those people to go, oh, wow. When you're meeting with people at networking marketing events or whatever these different, events are, and you get someone's address or their contact info, and you write them a handwritten letter, man, I promise you, they remember that. Because think about the last time you got a handwritten letter or thanking you. Like, I don't get those very often, but when I do, I think, wow, they are quality people. They are next level. They are a step up. So I think that's a great way to do it. Is handwritten. The art of handwritten letters is a lost art, and we have found it is incredibly successful to build rapport and a sense of an obligation, if you will, to kind of repay that social debt. So yeah, that'd be a great thing, I think.
Love that. Stand out, consider handwritten letters. Love that, Thomas. All right, we're going to go in a slightly different direction for this last question here. I believe you're out in the Arizona, somewhere in Phoenix, right?
That's
Give me
right.
your favorite place to grab a bite to eat.
Ooh, okay, good. Chelsea's Kitchen is great. Chelsea's Kitchen is right on the canal, and it's great kind of backyard patio, and they've got fantastic food. So I love Chelsea's Kitchen.
Chelsea's Kitchen it is. Well, Thomas, you gave us a lot of great information today. I loved hearing about kind of your background in the military, making that transition on the brokerage side first, then becoming a principal, and some of the things that you're focused on. You talked about, investing in development and distressed debt, but you also talked about as you're investing, leaning more towards kind of the newer assets, the Class A assets, recognizing that those are going to be more in demand than some of the Class C stuff, particularly when the economy is a little bit softer. So just understanding the way you approach your investing thesis about kind of long-term wealth accumulation, and now also just sharing more about kind of your background, your story. And I really enjoyed hearing about the investments you made early on and just some of the lessons you learned down that path. Again, for folks that want to learn more, they can go to Lookerum. Did I say it right this time?
That's good.
I don't know if I put an extra little roll in there for some reason, but Lookerum, LUKROM.com. We'll put that in the show notes again, LUKROM.com. Thomas, thanks again for being a great guest and coming on Multifamily Insights. We look forward to staying in touch with you, and I hope you have a great day.
John, thanks so much. And I hope that everyone enjoyed it as well. And you do a great job. So I just want to say, not only on my behalf, but on behalf of the listeners, you're out there doing some good, man. So thank you.